If you're invested in the US stock market, or if you have any exposure to these AI stocks, then you might want to listen up because the AI stock market bubble story is absolutely everywhere.
The possibility of an AI bubble.
AI bubble.
AI bubble. Are we in an AI bubble? Of course.
The S&P 500 is hitting all-time highs, and AI stocks like Nvidia, Microsoft, Google, Palantir, AMD and Oracle have skyrocketed. And it's got me thinking about my own portfolio and what do I do if the AI bubble bursts. Now, when you've got optimists like Cathie Wood calling for a reality check, Warren Buffett sitting on $344 billion in cash, and Deloitte even being caught out using AI to write a $440,000 government report, it's probably time to objectively think about the inevitable and how to navigate it. So today I thought we could unpack the current risk factors contributing towards this AI stock market bubble and how current valuations could affect future market performance, and also what I'll be looking to do with my own portfolio when the inevitable occurs. Quick disclaimer though, this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when you're investing, your capital is at risk. Let me show you this video.
Yo, he stole my chicken!
Got a crispy treasure, can't slow me down. Hot and golden, I'm out at this town. Move, move.
Of course, it's an AI video which has been created using an app called Sora, an AI tool developed by OpenAI. Now, whilst this video can bring back historical figures like Michael Jackson, which I guess is pretty cool, its commercial value certainly goes beyond that of silly Instagram reels. To me, it shows a snippet of new era technology, something that stretches the limits of our imagination and possibility. But that imagination is yet to be profited off of, because a study by MIT found that 95% of AI pilots in companies are actually failing. It shows that while stock prices are rising, it's not fully backed by underlying fundamentals, and instead we have the perception that future value will be generated at some point in the future, causing some kind of level of market euphoria that we've arguably not seen since the dot-com bubble. So it's a little hard to ignore the growing risks that are present, and it's making me feel a little bit more cautious about my own investment portfolio, in that history, I guess, could potentially be repeating itself.
Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place.
The IMF have just released this. It's a global financial stability report, and the publication assesses the health of the global financial system and its markets, and it's got some pretty insightful information in here. It's 100 odd pages long, and if I'm honest, I'm not going to pretend that I've read the whole thing. However, there are a couple of insightful things that I wanted to share with you. And the first that stood out to me was this line, where it says, a measure of concentration risk based on the Herfindahl-Hirschman index is now substantially higher than during the dot-com bubble. Now, this index was created back in 1945 by two economists, Ulrich Herfindahl and Albert Hirschman, and it's based on this formula. But all you need to know is that it's a way to assess how competitive or concentrated a market is. And as you can see from the green dotted line on this chart, markets are far more concentrated now compared to what they were in the early 2000s. So much so that the report states that the Magnificent Seven currently accounts for 33% of the S&P 500 index, versus the top 10 stocks in the late 90s, early noughties, which accounted for only 27% of the index at the time. The potential issue here is that returns for investors like me and you guys are becoming far more reliant on far fewer companies. And whilst investors have seen the benefits of this in recent years, given that the Magnificent Seven made up over 50% of market returns in 2024, the downside risk here is that we could have a monumental size problem on our hands if and when these 7 stocks start to underperform, and this is why. The Mag 7 companies have a combined market value of $24 trillion at present. So even in a context of a mild 20% market decline of even distribution, this would be the equivalent to $5 trillion of market value being absolutely decimated, which for context is $1.7 trillion more than the total economic GDP of the UK. And that's certainly not beyond the realms of possibility. After all, the S&P 500 declined $2.4 trillion in a single day earlier on this year as a result of tariff announcements, which perhaps shows how on a knife edge that markets are. The IMF report outlines a word of caution, in that a forward-looking risk is for the effect of tariffs to eventually lead to a margin compression across most S&P 500 sectors, including the Mag 7. At this point, a deterioration in corporate profitability against substantial AI-related investments, the possibility of mega-cap stocks failing to generate expected returns to justify current lofty equity valuations could trigger a deterioration in investor sentiment and make stocks susceptible to sudden, sharp correction. But for now, corporate profitability appears healthy, and markets are still very much optimistic. But the IMF's message is clear. Stability built on high concentration isn't stability at all, it's exposure. But that exposure doesn't just sit inside our investment portfolios, it's actually being amplified right now due to how these trillion-dollar companies are borrowing, spending, and transacting with each other. Let's now take a look at how this raises the stakes substantially for this already inflated market bubble. There was this interesting article which was published by Bloomberg with the subtitle, "A wave of new deals and partnerships are escalating concerns that the trillion-dollar AI boom is being propped up by interconnected business transactions." And let me just tell you, the rabbit hole that I've been down whilst researching for this video was deeper than I ever thought that it was. It all revolves around a company called OpenAI, which is the company that owns everybody's favourite AI software, ChatGPT. They've secured about $1 trillion worth of business deals, but there are 3 extremely high-profile ones that I wanted to share with you. And I think what you'll quickly realise is that there's a couple of problems here. First, we've got Nvidia that will invest $100 billion into OpenAI, tied to the delivery of 10 gigawatts of AI infrastructure deployment. In return, OpenAI will then commit to buying the chips from Nvidia in order to provide a return on investment to them. The first issue here, well, Nvidia don't have $100 billion in cash sat on their balance sheet to just give to OpenAI. But if we turn a blind eye to that for just a second, because Nvidia will just borrow the money, this announcement alone created $70 billion in market value for Nvidia the day it was announced. Now, with OpenAI's newfound cash injection and of course higher valuation now, they can go on to raise capital either from investors or from the bank based on that newer, higher valuation that they have, allowing them to fund the next round of deals which I'm about to share with you. A $300 billion deal with Oracle then gets announced, with Oracle citing 359% growth in revenue projections, causing the stock to jump 36% in a single day. Then AMD entered the frame with a new 5-year deal where OpenAI will buy $100 billion worth of chips, and in return, AMD gave OpenAI 10% of their stock, which of course caused AMD's stock price to rise 23%. Although I'm not complaining about the AMD deal as an AMD shareholder, but it does raise some concerns that these companies are taking the "I'll scratch your back if you scratch mine" approach to business, with artificially creating revenues, if you like, leveraging cash, and of course increasing stock valuations. And that's just 3 of the web of deals that have been taking place in the AI space, which are not only inflating market prices for a number of different stocks, but they're also binding the fates of many of these different companies together. What I find particularly unnerving is that OpenAI have been able to spend all of this money with their newfound valuation of $500 billion, but they don't even expect to be cash flow positive until near the end of the decade. But it is much of the same when it comes to a bunch of other AI startups, as reported by the FT, all who are loss-making but are valued in the tens if not hundreds of billions of dollars, and these are all just private companies, they're not even listed on public markets. So it's no wonder that analysts are fearing another dot-com style crash. And all of this circular spending and deal making hasn't just inflated market optimism and market prices, it's also massively increased market valuations too. So let's discuss that next. All of this spending interaction has sent financial markets to record highs, and as a result, the inflationary adjusted price to earnings ratio of the S&P 500 is now reaching close to dot-com levels of 40.5, surpassing the prior peak of the pandemic where the US stock market experienced a shock of 32% of a decline in market prices. And whilst the IMF have referenced that if returns don't meet expectations, we could see a sudden shock to the market, as a longer term investor, I guess what I'm more focused on and what I'm more conscious of is buying in at these currently inflated valuations and what that looks like for my future returns. To analyse this more, I found a piece of research from JP Morgan that showed the relationship between the forward price to earnings ratios and the subsequent 1-year returns of the market, a short-term view if you like. And as you can see, based on all of the historical plotting on this diagram, the higher the price to earnings at the beginning of the period, as you can see on the x-axis, typically the lower percentage returns on the y-axis, as you can see by the overall downtrend in the results. Now with where we're at currently, the 1 year returns forecasts could be somewhere in the realms of 5%, based on the current trend, far below what we've become accustomed to in recent history. It actually highlights that we're far off optimal valuations for 1 year returns, which appear to cluster between anything from 12 to 18 times forward earnings. But as I'm a longer term investor, now let's take a look at what valuations tell us about the likelihood of longer term returns. Well, again, from the overall trend, you can see with valuations so high, the expected annualized returns over the next 5 years could be around break even. Not exactly what you want to see when you're investing into the market to grow your wealth over time. So now let me share with you how I plan to navigate that within my own investment portfolio. I don't have a crystal ball, so I can't say when the market crash will occur, and nor can anybody else out there. It could happen today, tomorrow, next week or next year. It could have even happened by the time you've seen this video. All I can do is have a strategy for as and when a market crash occurs and we see increased volatility in the market, and therefore how to best navigate it for myself and my own portfolio. But the first thing that I'll say is that patience and time is the best friend of the investor. Because when a market crash does occur, I don't know how big it's going to be, because they're varied in size and scale throughout the course of history. The biggest was the Great Depression in 1929, where the market declined 79%. We had the 2008 financial crisis, where markets declined 56%, and the dot-com bubble, where the market crashed 47%. So regardless, I'd be facing into some pretty heavy declines within my investment portfolio. But I'm only going to lose money if I sell my positions. And as a long-term investor, the way that I look at it, as I have done in the past, is that as and when market prices are declining, I will actively cost average into the market to lower my cost basis, because I believe that that's the best strategic play over the course of the long term. Let me explain why. Let's say I bought a FTSE All-World fund today, and 1 unit of that fund was £126.62. That would be my overall cost basis. But if market prices drop by 10%, this fund would be repriced at £113.95. And let's say I decided to buy another unit, but then the markets declined even more by a further 20%, where this fund would then be repriced to £91.16. And I decided to buy a third unit. My average cost basis from these three individual investments would be £110.57. Yes, the difference between the market highs of £126.62 and the market lows of £91.16 would be the equivalent to a 28% decline in market prices, which of course would be pretty painful to witness. But as and when markets recover back to all-time highs, which historically they have always done, back to that £126.62 price point, based on my average cost basis, I would actually be sat with an unrealised profit of 14.51%. Whilst that's all hypothetical, that's the strategy that I'll look to deploy if and when market prices go on to decline. And in an ideal world, I would look to deploy more money into the market as market prices became even lower to lower my overall cost basis, because I'll only go on to capitalise more when markets go on to recover. Because that's all part of the game of investing, right? Markets rise and markets fall. What matters is how we act in between. Patience, discipline and belief in the future of capital markets is how I will survive this within my own investment portfolio and grow that investment portfolio over time too. Now, if you're absolutely new to investing and if you would like to know how I would start all over again if I had to, then be sure to check out this video next. Be sure to subscribe to the channel whilst you're over here, and with that being said, I'll see you over in the next one.